Andrew is a guy who likes to watch macro charts and think about the economy and the way you've discussed markets with us now over the past year. What does someone like you even, include GameStop? How do you think about it? Is it anything, or is it just noise and you block it out?
So a little bit of both. It's definitely something that's been entertaining, and I think a lot of it has to show how hard it is to go short companies, right? Those specific hedge funds. In fact, Citron earlier this morning came out and finally said that they're no longer publishing short sell research after 20 years. Very successful investment. So when you start seeing what's going on, it's the proliferation of retail investors, also the proliferation of active use option trading, and then the profound implications of what comes from option trading with margin calls, maintenance requirements. So it's been pretty intriguing so far to watch. But yeah, from a macro perspective, it is a little bit of noise within the process, how we go about looking at the overall economic recovery and really the other value trades that are out there. I heard you talking earlier this morning. I mean, yields have been moving up for the last 8 months, and that has great implications to very cyclical asset classes that we have seen outperform for the last 6 to 8 months. It's delivered great outperformance relative to the headline indices so far.
Andrew, is there a implication here that shorting companies that were beaten up during this crisis is not going to be a winning formula? I mean, I know that this has been particularly targeted, obviously, and there's a few others too, but it also just seems that, at least for this case, as opposed to like pumping Dogecoin on the internet, I guess pumping an AMC or a brick and mortar retailer like GameStop is much more reasonable, right? I mean, I'm looking around and it seems like things are just waiting for the all clear to get to some pretty robust economic activity.
Yeah, definitely. So let's just break it down this way. We've seen the Federal Reserve pump massive amounts of liquidity into the system, right? That has allowed zombie companies or companies without an operating profit last for over a decade. So we have seen short sellers come in and really try to, extrapolate into the events that fundamentals aren't there for specific names. And let's be honest, we need short sellers within the market. Short sellers have exposed names such as Enron in the past. And so it helps us know the viability of some of these companies. But then again, it makes the job a lot harder when the Federal Reserve has distorted the game with the amount of liquidity that we've seen flushed in the system. So again, short sellers are needed, in my opinion, through proper market dynamics. But given the amount of liquidity we've seen, given the access to the retail side of the market, it just becomes a little harder given the social media's presence and hyping up the demand for these specific names.
Andrew, let's talk about what you like in the market right now. I look at the ETFs that you want to be in: Energy XLE, Materials XLB, Financials F. This seems like a very clear cyclical positioning. What needs to happen really to finally let the lid loose on some of these trades that have stopped and started and started and stopped?
It's definitely been not a linear growth, right? We've seen a lot of back and forth. Where it comes down for us is in December, we really were talking about a pause that refreshes or a turn within the market. We think we finally started to see that in January. This week gave us that episodic bout of volatility. In fact, if we look at those cyclical sectors over the last 3 to 4 weeks, they've been underperforming our more defensive counterparts. Why is that happening, Oliver? It's because the economic momentum has started to wane a little bit. Doesn't mean it's stalling. It just means that its rate of change has just slowed its pace for right now. We do think that the economic prospects still continue to the upside throughout the rest of 2021, which will help yields lift higher, which we're seeing today, which in turn reflects higher commodity prices, which help industrials and materials, and then yields obviously helping the financials game. For instance, we saw Caterpillar report this morning, right? It's all about earnings revisions, positive earning revision ratios. And so while Caterpillar did miss, it missed much less than expected, and that's where the market will be trading and be bidding up companies that beat in that aspect.
Andrew, in terms of the overall status of the recovery, are you impressed by the data we've gotten? We've heard language from the new administration that things are going to get worse before they get better. Do you think that's the case, or are we near the worst for the economy and near the worst for the virus? I mean, isn't the case for a lot of these companies on the cyclical side and the sectors essentially just a virus analysis?
Yeah, so I think it comes down to two sides of the recovery, right? The financial asset recovery has been nothing but spectacular. And we know that in the economic recovery, we have a lot of individuals, a lot of service sectors that are still coming back online. But looking at Governor Newsom's California plan, he's starting to open things back up. So I hope that the worst actually is behind us from a real economic perspective. A lot of these hard-hit households will hopefully get another stimulus check that really do need the money. And then hopefully we will start seeing jobs open back up as more vaccine distributions become available. We saw J&J talk about one of their vaccines this morning. And while it was less effective, there's more companies that are just issuing a vaccine or having the probability of a vaccine that is available. And I do think that we're on a solid footing, and growth will actually impress more to the upside to the administration than what they're alluding to right now.
Okay. Andrew, when you look at this and think about how to get exposures, are these just long trades? Are they buying ETFs? Are there ways to kind of amplify through either option strategies or specific companies that have the higher beta in this group? Or do you like this broad sector play?
So our portfolio construction really kind of centers around, let's get those betas, right? Let's go get those specific sector ETFs that get us that beta exposure. So for instance, Caterpillar is another trade that we have put on top just to give us a little more of that momentum within that specific sector. Same as Comerica for financials. And so what we look at is if we really want to start amplifying more of the higher beta portfolio, which we think higher beta as a factor will do well, we look at factor exposure ETFs. So the S&P high beta, which is SPHB, actually has done phenomenally well. Going out into the option market to really juicing up your portfolio for options on those ETFs is something that is viable. Obviously looking and learning right now with what's going on in the option market as far as margin calls and margin requirements, definitely want to be aware of how to trade those properly. But we think factor exposures through factor exposure ETFs really will help generate that extra alpha within your portfolio using that high beta or that Russell Pure Value ETF.